Everybody, what's up? We are back with another stock analysis, and I am currently drinking milk out of a wine glass, which means the only stock we can be looking at today is Papa John's Pizza. So, Papa John's has been on a very, very severe downtrend for many years now. Their same-store sales have been declining very consistently, and that is not great. So, what we're going to do is take a look at the stock, go into their financials, give them a bit of a valuation, as well as go through their recent earnings report, and really just see what is going on, give you a good idea of where the stock is at from a financial standpoint. So if you're interested, make sure to subscribe. I make these videos basically every day of the week. And yeah, let's get into Papa John's. So for anybody that does not know what Papa John's is, they're essentially a pizza business. They make pizza and related things like that. And they mostly focus on delivery and carryout services with those. So they have restaurants basically everywhere, and it's mainly focused on delivery. So big thing to look at right off the bat here is, like I said earlier, their same-store sales have been decreasing fairly rapidly, actually. Like 2% or higher consistently over each quarter is not great. Their number of stores is going up a little bit. In fourth quarter, they did increase their amount of stores, at least with the estimate they are, which is good, but overall, it's really not anything crazy, I would say. They did actually have a quarter-over-quarter decline earlier this year, or earlier in 2024. You could also see the number of stores that closed. So in 2023, they closed 118 stores, but they opened 326. So those are fairly good ratios, I would say, especially for restaurants, basically 3 opens to 1 close, which is pretty good. Other than that, you can see their domestic company-owned expenses, which are set to increase slightly, but overall staying the same throughout 2024, which is perfectly fine. And then the margins of their restaurants, which honestly, this seems like it's kind of high. I don't know what margin this is. I'm expecting it to be an operating margin, so not entirely profit, mostly based on their operations. But overall, there was a decline in 2024. They're expecting their fourth quarter to be a bit of an increase from their past report, which obviously was not very good, but they are expecting a little bit of an improvement there. So that is something to be optimistic about. But moving ahead here, market cap. Now, this is something that was kind of shocking to me because I feel like this is a very large company. At least I thought so. I thought they were much larger. But market cap at 1.2 billion isn't really that crazy at all. That's actually very, very low. And one thing that we could see here, if we just go down quickly, their sales are well over that per year. 2 billion in sales consistently for the past 3-4 years. That's kind of crazy to think about. So their market cap is very, very low. Actually a fairly high dividend yield. A lot of that, though, comes with the decline in their stock price, which I could show here. Their stock price has been very, very significantly declining since the peak in 2021. So they really haven't seen a significant uptrend since then, which is not great, but it also could be a buying opportunity possibly. But based on their same store sales just decreasing as much as they are, I don't think so. But that's just my opinion. Anyway, moving down, target price is at $55 a share. Long-term growth rate is at 5.125%. So right now we are at $40 a share. So there is a bit of upside based on the target price there. However, I'm going to continue going down here. And actually, I was going to say the growth summary will probably say something different, but their growth summary is across the board positive. They're expecting very good growth, especially within the next 3 years. Their long-term 10-year growth is fairly low numbers, but if these numbers can hold up, it could completely turn around their business. And that is also something I'm going to get into now as we head into their income statement. So they have been declining in sales, I think, or at the very least not growing very much. So you can see this is the past 15 quarters here. And back in 2021 and 2022, they had higher sales per quarter consistently than they do now. So past 2 quarters were at 507 and 506, which is hundreds of millions. And they were consistently above 510, 520 every single quarter up until these past 2 quarters. So they have seen a noticeable decrease in sales, which wouldn't be a terrible thing if their profitability was also increasing, which if we look at the last quarter, their operating income was actually much, much higher than any of these other quarters at just under 70 million. Same exact thing with their net income, where they saw 41 million in net income, which is way higher than any other quarter we see here. So in the past quarter, they have seen very, very good results, which honestly is pretty impressive. They are actually up a lot today. If we look quick, they're up 6% today already. And I think what that is people are anticipating this most recent quarterly report that's coming up towards the end of February. So that is also estimating, again, above that 510 million mark, which they did not pass in those past 2 quarters. So could be a very solid thing if this next report is really good and we see this increase in profitability continue. This kind of big of a jump up in operating income and net income compared to what they have been doing is very unexpected, but also really good. Shows a lot of improvement in the company over the past couple months. So overall should be a really good thing. Looking at their basic shares outstanding, they have been reducing it fairly consistently, although for the past, I shouldn't say that. Over the past couple years, it is down. However, for the past few quarters, it was very slightly increased. So they have, I believe this is in millions, 32 million shares roughly, and they have been very, very slightly adding more, it looks like, since March of 2023. So they are selling a little bit of stock, but overall it's a very, very negligible amount. So nothing to really be worried about there. Now let's head into the balance sheet and see what their debt situation is. That is the biggest thing here. And I'm kind of expecting it to be a lot, but hopefully not crazy. And so far we're seeing, yes, it is a lot. So 17 million in cash, 38 million in short-term debt, and over 900 million in long-term debt. So overall, that is not fantastic. It's not a crazy amount of debt either, to be fair, just considering it's not. I don't even know what to say here, because on one hand, they do make hundreds of millions per quarter, and they have just seen a record net profit over the past few years at least. So their debt situation might not be fantastic, but I think it could be improved at the very least. It has been coming down, it looks like, since also March 2023. So they have been working to reduce it, which is a good thing, and I'm glad they're doing that. But overall, it is very high, especially considering their cash position. And actually, all of their assets combined are not worth what their long-term debt is worth. So that is not great either. So overall, debt situation, not very good. Moving on to the cash flows. See what is going on here. So operating cash flows. So one thing to say here is they did see that very high operating and net income coming in for the past quarter, but their cash flows are very decreased compared to the quarter before, which is a little interesting. So you can see a lot of that negative for this came from other funds. Not 1,000% sure what that means, but basically it just means that they had less cash coming in through operations. And actually, you can see here their funds from operations also decreased basically by half compared to the quarter before. So I'm not entirely positive on what their much larger profit and operating profit came from, but it did not really translate into their cash flows at all, actually. So that is definitely something interesting. I would say having very positive cash flows is a little bit more important than having like better operating profits, because ideally you want to have more and more positive cash flow that you could just continue pushing into the company. But then again, that net income is kind of the same thing, where they can put a lot more into it. And what most likely happened here was, because their net income was so much higher, they spent a lot more on putting stuff into other funds that then decreased the overall cash flows, but they still used that money for something to improve the company. So that's most likely what happened there. Moving on to the investing activities, CapEx is fairly consistent. Looks like we're just about in the fairly consistent 15-ish to 25-ish range here. And right now we're on the lower end of that. So that also could have helped with driving profits a little bit more. They're just spending on the lower end of their CapEx. Other than that, no acquisitions No significant acquisition movement recently at all. They have been selling off some assets and assets, fixed assets and businesses recently, but not a crazy amount either. Realistically, their cash flows do not amount to crazy amounts of money. And that's not really a bad thing, but also they have spent a lot in the past quarter into reducing debt, which is awesome. You can also see their dividend has been very consistently increasing. A couple years ago, they were spending 12 million, and now they're at 15, actually over 15 million. So that's always good to see. And other than that, it looks like they ended up with a negative free cash flow. So what I'm going to say for that is, despite the kind of much higher net income coming in, it looks like they put all of that increased profit into reducing debt and into other funds here. So, not a terrible thing, but also you really don't want to see negative free cash flow overall. But for a short term thing, it's not really that bad at all. So, overall, I'm going to say mixed results with the financials so far. It's it's hard to say whether this is overall good or bad. I would say their debt situation is a little shaky. Cash flows look okay. They are usually positive with it. But again, seeing that negative cash flow despite the much higher net income is just a little bit concerning. But overall, I'm assuming they just spent more money on reinvesting into the company there. So hopefully that is what's happening. And we'll definitely be able to see that in the next quarterly report that comes out. Have there been improvements since then, which hopefully we can see. So now getting into the ratios, I'm going to have to head into the last 12-month quarters here. And hopefully we see some positive trends. So one thing to again highlight, this is their past reported quarter, including the average of the last 12 months. So this is not their last quarters, which unfortunately they don't have the margins for their last quarter. But this is the last quarter and an average. So right here we can see gross margin is at 16.9, which is right around the middle range of what they've been seeing recently. A little bit of a decrease from the quarter before. Actually, both quarters before this one, there was a little bit of a decrease. SG to sales is at the lowest we have seen in about 4 years now, which is awesome. That's very good to see they're spending less money on their SGA to sales. However, we also do need to realize that, especially in this industry where there really isn't too much difference between products, it's mostly about, can you offer unique things? I feel like advertising is very, very important for a company like Papa John's to be able to compete in their industry. So if they are spending less on that, that could project less future growth, just because they won't be able to get themselves out there as effectively. But hopefully it's just a means of them cutting costs while still being effective. That would be the best case scenario. Next, their operating margin and their net margin, you can see the fairly significant tick ups from the quarters before, going all the way back with operating margin, at least going all the way back to, it looks like 2021. We have not seen anything nearly this high, which again, we did discuss earlier. Same exact thing with net margin. And one last thing I want to look at before we get into their earnings is their debt to equity, which their equity is apparently negative, which would make sense because they had much more debt than their assets. So to balance that on the balance sheet, their equity does need to be negative. But overall, debt to equity is not great. I would say they have way too much debt, just flat out overall, a lot of debt. They have been working to reduce it, as we saw. However, in my opinion, it's too slow. But again, they also don't have very much cash on hand. So it does make sense. But at the very least, there is an effort towards reducing that debt, which is always a positive thing to see. And let's now head into an earnings report and see what we can find. So fiscal year and quarter four report will be out February 27th. So definitely look out for that. I think that will be huge for the company. And let's get into their metrics and see what's been going on here. So comp system-wide North America, we're seeing a larger negative. Company owned is also a larger negative than estimates. North American franchising is in line, but again, also negative. And system-wide international, also more negative. So overall, everything is much more negative than was expected, which is not great. I don't know exactly what comps means, to be fair. This could just be their segments and how they've been performing with margins, or also just revenue growth. But overall, we could see in revenue, company-owned restaurants came in under. Franchise royalties and fees came in slightly above estimates. Commissary came in above estimates. International came in slightly below, and other came in slightly above. So little mix there. Overall, I would say positive though. However, their biggest thing, actually their second biggest, is company-owned restaurants, which you would think would be the best managed of their restaurants. But they did fall short of estimates by just about 2 million, which isn't a crazy number. If they were maybe 20, 30 million below, I would be a lot more concerned. But overall, it's mostly in line. So not too bad there at all. Restaurant margin was also below street account estimates by about 2%, which is a very big gap. That's not great. And I'm sure we most likely saw the stock drop a lot on November 7th, if I had to guess, which if we go to that last earnings report, we could see down 4.6% and continue to drop for essentially the next 2 weeks or so before finding a little bit of support. But again, since that earnings report, we have seen the stock drop a lot. And actually, if we go in here and we go to that close of the day there, from that earnings report, the company is down 25%, which is basically 2.5 months. That is not good. It really highlights just how bad that report was, especially falling short of that restaurant margin. That's a really big deal. And then also operating margin overall came in a little bit below estimates. So not great. Let's get into the street takeaways and see what analysts are saying about the company. So overall, Fields management is focused on driving value perception versus competitors, as this appears to be the primary factor weighing on comps. Other than that, met expectations while international was below. Calls out continued challenges for comps. Target 45, target 60, target 62, and maintains a perform. So no price target drops really. And actually the average price target after this increased, if we look at the bottom here, to 4.8% higher to $60 a share. So based on this report, which I personally think is fairly negative, I would say mostly negative, they increased their price target. So something to consider, a $60 price target would be a fairly good high from where we've seen. That's basically the high before the last earnings report. So if that could be achieved, it would be a fairly positive thing for the company, just regaining a lot of that value lost after that negative earnings report. But overall, there is still so much more work that needs to be done towards regaining a lot more value in the company and also getting back investor confidence, which it seems like they have definitely lost a lot of over the past few years. Other than that, let's look through the overview here. So system-wide NA comps are modestly better than anticipated, while international missed. Domestic company-owned restaurant margin was down, missed by 210 basis points. OM year over year was also below by 10 basis points. So comps remain negative. There was an optimistic tone from some analysts as management seeks to improve their brand. New CEO, which I did not know about. They have a new CEO, which sometimes can be really good. Look at Starbucks and how they're doing right now. If we go into here really quick, Starbucks just got a new CEO and their stock price has been fairly consistently going up. So overall could be a really good thing. For Papa John's, hopefully that is also a good thing, but we'll have to see. Investments, likely a drag on margins. International continues to lag. Gross outlook viewed indicating slow improvement. Emphasis there is definitely on the slow part. If the improvements that we need to see to get this company back to where they were are too slow, they're just going to end up in a situation where their valuation never sees anything near where it used to be. Investors want returns and they want them as fast as possible. So if it takes this company 5 to 8 years to really get back to their good outperforming performance, they're going to lose a lot of investors by then. And by then it'll probably be a not great situation for the company. Fail to see catalysts ahead as performance likely to be volatile. So not anything too optimistic here. I would say it was a little bit half and half towards the negative side. However, all the price targets remain the same, maintains an outperform, maintains a perform. So it's mixed here, to say the very least. It is mixed. And now let's get into my own valuation and kind of see what we can get to here in terms of a price. Sometimes this works out very well, and actually this one will be fairly good. However, I might have to get rid of Nebius here because they have a crazy PE ratio, and that's going to skew it fairly well. But one thing to note is that Papa John's has a much, much lower PE than any of these other named competitors here. So we're going to put in 22.89 and 24.49 in here and see what pops up. 22. And of course, I already forgot what it was, 24.49. And that gives a valuation of around $68 a share with a 65% upside from the current price, which roughly falls in line with the analyst price targets, which we saw. Average here, the target is at $60. Target here at 62, target at 60. This one is at 45. But overall, that does fall into this range slightly. To be fair, though, I am only comparing it to 3 other companies currently. There was another one, but their PE ratio is insane, so it would just massively overvalue Papa John's. But based on the fact that these other companies are very consistent, I would say definitely holds up fairly well. Obviously, don't base any investments on this company on that kind of price. I certainly would not. Please do your own research. But overall, that's the price based on their competitors' PE ratios and where their PE ratio could be as well. So definitely something to consider. Compared to their competitors, they are considered very undervalued. So interesting thing there. Other than that, I think that's all I have for Papa John's today. So thanks so much to everybody for watching. Make sure to subscribe if you haven't, and I will see everybody in the next video.